Good evening and welcome to the Wealth Empire Weekly Market video. As many of you probably know, Warren Buffett's firm Berkshire Hathaway has its 50th anniversary shareholder meeting coming up in about a week and a half in Omaha, Nebraska. This is always a big event. Generally, somewhere around 40,000 people flood the city for it. Some of you may be going, and in anticipation of that, I'd like to spend a few minutes tonight reviewing his current portfolio, looking at any additions he recently made, and then showing you part of a study which is going to mathematically show how you can use stock screeners and filters to put together a list of holdings and purchase stocks based on Buffett's philosophy that has outperformed the market substantially. So Buffett's 13F filing was released a couple of weeks, or about a week ago, I guess. So we've got the numbers. Here's an Excel spreadsheet showing his current portfolio. And this is showing each of his current holdings listed in descending order by percentage weight of the portfolio. So starting at the top, we have his largest holding, which is Wells Fargo Corp. Followed by Coca-Cola, IBM, Amex, Walmart, Procter & Gamble, and on down the list. And you can see the sector weighting right here. So in other words, what percentage of Berkshire funds are in these stocks. He's holding about 47 securities right now, but about the top five of these make up somewhere around 60 or 70% of the Berkshire portfolio. So he has a really concentrated holding among these top five. Now, this doesn't tell us a whole lot, right? We know that just because he's holding a stock doesn't mean it's a great time for us to buy it. So I've broken this down a little bit further by sector weighting, and here's the same securities he's holding, broken down by which area of the stock market these securities lie. So we notice two big categories right off the bat that make up the bulk of Berkshire's portfolio. Financial services comes in at 43%, and consumer defensive stocks at 25%. So what this is telling us is these are the areas that Buffett sees the greatest value and the greatest opportunity for the future. As far as financial services, is going to include banks, wealth management firms, things like that. And these are, as a sector, generally trading at lower multiples of book value and earnings per share than most other stocks in the market. And Buffett is a deep, deep value investor, and this is likely why he's allocating so much of his $100+ billion portfolio there. But once again, what he's currently holding really doesn't set off the flashing lights to us saying that's what we should be buying now. So, as a lot of you probably know, I like to focus on new buys or significant additions to their current holdings. So, what you're looking at here is the buying activity from the Berkshire Hathaway Fund during the first quarter of 2015. Now, there are no new positions, but there are these, seven additions to current stocks. So, a lot of these are pretty minimal, right? 1.5% to Wells Fargo, U.S. Bank Corp, IBM, Deere. But the bottom three here show a decent addition. So this is where he's really put the dollar during the fourth quarter. It's Phillips 66, PSX, 21st Century Fox, Fox A, and Precision Cast Parts Corp, PCP. So you're seeing what percentage he increased those shares. Now, what I've also done with these is take a look at the price range the stock traded during this quarter, right? We don't have an exact fill price because, again, when you're pushing $100 billion around, you're not getting filled to the tick. I mean, he's got traders and he's calling them saying, buy me up, X number of shares of PCP between 200 and 225. So we'll take Precision Cast Parts, for example. The stock traded during the quarter between 199.63 and 238.44. So the median trade price was around $212 a share. Well, it's currently trading just under 208. So clearly, we're well within this range where Berkshire likely bought. Still a solid opportunity for us to get into it. You want to do some due diligence, see if this opportunity makes sense for you. But this is kind of the biggest purchase, at least on a percentage of portfolio or percentage increase, that Buffett made during the first quarter. Now, I mentioned I want to show you a study about Buffett and about how to replicate his success. So I want to go ahead and take a look at part one of this, entitled Testing the Warren Buffett Method. Now, I've studied Buffett's methods for years, and And after doing so, I believe that Warren Buffett's entire investment philosophy can be summarized in 6 words: buy quality businesses at reasonable prices. Instead of following the herd and speculating on what the markets may or may not do over the short term, he selectively allocates capital to investments offering the greatest value for shareholders. It's just that simple. So let's put some science to the Oracle's methods. While few people can hope to match his legendary success, we can take cues from his actions and use those to greatly increase our chances for profit in the market. So by creating a mathematical model to backtest his fundamental investment criteria, we should be able to not only judge his philosophy systematically, but also replicate his search process going forward. We're going to be examining the period from 1998 to 2008, and this time frame was selected because it includes both the greatest bull market in recent history as well as the most severe bear market. This piece of history represents a complete business cycle, so examination of it should yield an encompassing look at performance through both opposing market conditions. Now, Warren Buffett likes companies with the following qualities. 1. Simple businesses that he understands. Predictable and proven earnings. Stocks that can be bought at a reasonable price. And companies that have an economic moat. Now, simple business is the only variable out of those 4 that's difficult to evaluate mathematically, so we'll initially focus on the other 3. Luckily, most people know a simple business when they see one, and the most predictable and proven companies tend to be fairly simple and understandable. The other 3 qualities can be systematically scanned for and evaluated. Now, in late 2008, Dr. Charlie Tian published market research pertaining to these criteria, and we'll be using these findings for much of the analysis going forward. So let's start with Buffett's first criteria, which is predictable and proven earnings. For the study, we'll be examining the 2,403 U.S. stocks that were traded from January 2nd, 98 to late 08, for which there is complete financial data. We'll first evaluate the predictability of these companies based on the consistency of their revenues and EBITDA per share over this 10-year period. Any companies that had an operating loss in any fiscal year during this period are going to be considered unpredictable. Of the 2,403 companies studied, there were 570 that were considered predictable by this definition. And as you will see, these companies demonstrated much better stock performance than the others over our studied period. Now, as a disclaimer, the study may be subject to some biases and assumptions. 1. Dividend yields are not counted for in investment returns. Effects of price changes due to spin-offs may not be fully adjusted. And stocks are subject to survivorship bias due to delisting or bankruptcy. So let's quickly address those. 1, dividends are undoubtedly an important component of investment returns. By ignoring them in this study, we're essentially reducing investment returns by about 2% a year. But since predictable companies tend to pay higher and more regular dividends, this bias favors the average return of the non-predictable businesses. The effect of spin-offs is likely small in relation to over 2,400 stocks in our study, and therefore believed to be of little relevance. Finally, during the tech bubble of 98 and 99, fresh IPOs flooded the market, many of which were later delisted, meaning no longer exist as a publicly traded company. I believe this survivorship bias again favors the non-predictable companies, since they tend to lose more money and become insolvent at a higher rate. So these are the results of comparing the 570 predictable companies for that 10-year period versus the 1,833 non-predictable companies. We quickly see only 61 lost money versus 830. The number of stocks that lost more than 50% is far lower. Those that lost more than 90% is far lower. The average gain of these predictable stocks is 2.5 times the average gain of the non-predictable stocks. The median gain is more than 10 times greater. The only place that non-predictable companies exceed predictable is in this maximum gain column. That just means there is one stock that performed exceptionally well that beat this column over here. Maximum loss, each category had at least one stock that went to zero. But here's the big important numbers. The annualized average gain and the annualized median gain, you are clearly doubling, if not more, your performance in these predictable companies versus their non-predictable counterparts. And when you compare it to all the stocks traded during that time period, you see the same extreme outperformance from these predictable companies. Now, Warren Buffett has been often quoted saying that two rules guide his investment decisions. Rule number one, don't lose money. Rule number two, don't forget rule number one. And as demonstrated in the second line item of the table we just saw, investing in predictable businesses greatly diminishes this risk of loss. After 10 years of trading, over 45% of the unpredictable stocks were still losing money. Compare that with just 10.7% of the predictable companies. The largest gainer of this group was Hansen Natural Corp, which produced an 11,000 plus percent return over the period. However, the vast number of losing stocks from the non-predictable group all but wiped out this tremendous performance and produced an averaged annualized median gain of just 1.1%. If the delisted dot-coms, Enrons, and WorldComs were included in this average, it will be reduced even further and likely a negative figure. In addition, 22.5% of the unpredictable stocks lost more than 50% of their value. Compare that to just over 3% in the predictable group. And 4.5% of the stocks lost over 90%, compared to just 0.7%. Again, this does not include the bankrupt and delisted stocks that lost 100% of invested capital. So investing in predictable companies with a proven track record of earnings can dramatically improve your odds of following Buffett's rule number one. Purchasing predictable stocks reduced your risk of loss by 76.3%, your risk of losing more than half your investment by almost 86%, and your risk of losing 90% by over 85%. So this reduction of risk clearly outweighs the potential advantages of owning only speculative stocks. Next week we'll cover part 2 of this study. We're going to be examining business predictability, how to judge it, and how it increases an investor's rate of return. Don't miss out.